You have to pay taxes. It's the law. Local, state, and federal governments collect a variety of taxes for operation and administration, roads, schools, social services, police, and defense. Which levels of government collect taxes? Yes. You pay taxes on most goods and services you buy. Cars, gasoline, clothes, telephone service, cigarettes. You also pay property taxes on real estate you own. These taxes are the same for any consumer. The federal, state, and some local governments also tax the income of individuals and businesses. Your income tax varies depending on how much you earn, how you live, and how you spend, save, and invest your money. Besides providing revenue for governments, income taxes can encourage certain kinds of what? Right. Income tax rates are progressive. The higher your income, the larger the percentage you pay in tax on each successive portion of your income. You cannot wait until the end of the year to pay income tax. Your employer withholds tax from each paycheck and sends it to the government. If you're self-employed or receive considerable income from interest, rent, or dividends, you must pay an estimated amount of tax each quarter. What's the term for higher tax rates on higher incomes? Right. Besides income tax, employers also withhold taxes covered by the Federal Insurance Contributions Act, FICA. These Social Security taxes cover benefits for old age, survivors, disability, and medical care. What taxes are withheld from your paycheck? Yes. FICA taxes are not progressive. 6.7% of an individual's income is withheld. Employers match the FICA taxes for each employee. Since the FICA tax is calculated as a percentage of your income, can you do much about it? Right. Your income tax depends in part on your income, but it is influenced by other factors, such as marital status, number of dependents, contributions to charities and politicians, and the types of expenses, savings, and investments you have. The decisions you make and the records you keep can reduce your income tax. Are you justified in taking every legal means of minimizing your income tax? Yes, you are. Tax evasion, illegal measures taken to reduce taxes, is punishable by fines and imprisonment. But the government encourages you to take advantage of legal provisions to minimize your taxes. It provides tax reductions or deferments to encourage such actions, such as using solar energy or saving in retirement accounts. The amount of federal income tax withheld from your paycheck is determined by a table provided by the Internal Revenue Service, IRS. It considers your salary, marital status, and the number of dependents claimed on the W-4 form you filed with your employer. What is an illegal attempt to avoid paying taxes called? Good. At the end of the year, your employer gives you a W-2 form showing the amount of taxes withheld. Using this and other records you have kept, fill out an income tax return and file it with the IRS by April 15th. The government allows you to start and end your personal tax year at any time, but most individuals use the calendar year. If you have overpaid, you receive a refund. If you have underpaid, you must send in the difference with your return. You can get an automatic extension until June 15th if you file Form 4868 and send in the estimated amounts you owe. Almost everyone with an income must file a return. Some individuals with incomes below set minimums, which differ with age and marital status, do not have to file, but you must file to get a refund. Can you get the deadline for filing extended? Yes. Single persons must file separately. A couple married by December 31st may file a joint return or separate returns. On a joint return, both incomes are combined into one taxable income. A married couple generally saves taxes by filing jointly. Before 1969, single taxpayers were taxed more than married taxpayers. What about now? Consider Bob and Carol, who both work and are married, and Ted and Alice, who both work but are not married. Other things being equal, who pays more tax? Right. Employed married couples, whether they file separately or jointly, pay more tax than two employed single persons. Recent tax laws have reduced this marriage penalty, and for most married couples, the tax difference is not very great. Have married taxpayers always paid more than single taxpayers? Good. Income tax law is complex and frequently changes because the government wishes to accomplish many political and social goals, as well as obtain revenue. The IRS has tried to simplify tax forms and provides free publications and assistance to help you fill out your own returns. For simple returns, the IRS will calculate your taxes if you fill in certain data and sign and file the return. If your return is very complicated, you may decide to hire an accountant, tax lawyer, or private tax preparation service. What government agency will give you free assistance in filling out your return? Right. Preparing your return requires a series of steps involving income, deductions, exemptions, tax tables, and tax credits. Check for changes in tax laws each year. They affect what and how much can be claimed under the various categories. You must determine your gross or total taxable income. This includes income from many sources, including salaries, most interest and dividends over a minimum amount, short-term capital gains, 40% of long-term capital gains, prizes, alimony, rent, and so forth. Some of your income may be tax-exempt exclusions, which you should not include in your gross income. These exclusions include some military allowances, scholarships, gifts, child support payments, Social Security benefits, a portion of interest and dividends, and 60% of long-term capital gains. What do you call income that is not taxable? Good. Capital gains are the profit you make when you sell an asset like your home, car, or stocks for more than you paid for it. If you own the asset less than a year, your profit is a short-term capital gain. If you owned it a year or more, it is a long-term capital gain. What What percentage of a short-term capital gain must you include in your gross income? Right. You include only 40% of a long-term capital gain in your gross income. And when you sell your home, you do not include any of that capital gain if you buy a house of equal or greater cost within 2 years. If you're 55 or older, up to $125,000 in capital gains from selling your home can be excluded, even if you don't buy another. If you bought a home for $50,000 and sold it 4 years later for $70,000, and within 2 years bought another for $70,000, how much of the capital gain would you include in your gross income? Good. Once you have calculated your gross income, you need to calculate deductions. Deductions are certain necessary expenses. The first group of deductions, called adjustments to income on the tax form, includes mostly business-related expenses, such as travel and moving expenses, business losses and costs, as well as individual retirement plan payments and alimony. You subtract these deductions from your gross income to get your adjusted gross income. What is the name of expenses you subtract from your income? Right. The government allows another group of deductions for certain non-business expenses. These deductions include medical and dental bills, casualty and theft losses, interest on loans, some local and state taxes, and gifts to charities. Since the government assumes every taxpayer has some of these expenses, a standard amount is calculated into the tax table. If your personal deductions are greater than the standard or zero bracket amount, you may choose to itemize. Total your itemized deductions and subtract the standard amount. Then subtract this difference from your adjusted gross income. If you do not itemize, but intend to use the tax table, what do you subtract from your adjusted gross income for personal deductions? Correct. You list your number of exemptions on your return. You may claim one exemption for yourself, and when applicable, your spouse, each dependent, and the blindness and over 65 allowance. Which of these does not count as one exemption? Good. Your adjusted gross income minus the amounts for exemptions and itemized deductions, if you itemize, gives you your taxable income. Find your taxable income in the left column of the tax table. Move right to the column headed by your filing status: single, married filing jointly, married filing separately, or head of household. The figure you find is your tax liability. Most taxpayers are eligible to use the tax table. Some, such as individuals with incomes over $50,000, must use formulas called tax schedules to calculate their tax liability. Now you know your tax liability, either from the tax table or the appropriate formula. But wait, don't pay it yet. Some tax credits can be subtracted directly from that tax liability, perhaps part of child care so you can work, political contributions, energy-saving equipment, or other credits. Now, compare your tax liability to the amount you paid through withholding or quarterly estimated tax. If you paid more than you owe, you will receive a refund. What should you do if you owe more than you've paid? Of course. The government allows you to calculate your tax on a cash or an accrual basis. On the cash basis, your income and expenditures are considered in the year when you actually receive or pay them. The accrual basis considers when the right to receive or the obligation to pay occurs. Most businesses are on an accrual basis. What basis would you guess most individuals use? Yes. You may be able to reduce your taxes by income averaging, spreading income evenly over 5 years, or by income splitting, giving income investments to a son or daughter, or if you have a large income, by using a tax shelter, such as oil or technology development, with the advice of tax experts. Take advantage of every legal opportunity to reduce your taxes, but be sure to report all taxable income and to keep records for several years. The Internal Revenue Service makes a partly random selection of returns to check carefully. What is this check called? Right. An agent may ask you to come to the IRS office with your records. If you do not itemize deductions, you have only one chance in 100 of being audited. If your income is over $50,000, do you think your chances of being audited are greater or less than 1 in 100? Yes. Here it is, Form 1040. You may need to attach supplementary forms, such as Schedule A for itemized deductions, Schedule B for interest and dividends, Form 2441 for child care expenses, and so on. You may be able to use the shorter Form 1040A if your taxable income is low enough and you do not claim adjustments or certain tax credits and do not itemize deductions. The income tax regulations are complex, but keep your head. Read the instructions on the tax returns carefully. Watch for changes in the tax laws. Keep careful records. And get help from the IRS or a private tax expert if you're uncertain.